In this video, we're going to talk about Sofi Technologies, trading under the ticker symbol SOFI. Sofi Technologies operates in the financial services sector. It provides services of loan, refinancing, and credit cards, as well as wealth management solutions. It is a company based online and separates itself from conventional banks mainly from the difference between physical and virtual operation environments. Its appeal is the massive user base subscribed to its platforms, consisting of a large pool of potential paying clients, contributing to the fast growth and its revenue amount and in the number of revenue streams it can possibly develop. Sofi benefits from famous investors who are almost perceived as superstars in this day and age, and the fact that after years of discussions and speculations about what we would like to call a lightweight bank, it is now mature enough to be actually deployed to consumers at large. The trading volume of Sofi Technologies has recently been 24.5 million shares compared to an average volume of 31.1 million shares. Over the previous 52-week period, its price fluctuated between $12.82 and $28.26. The market cap of Sofi Technologies is currently at $10.8 billion, compared to an enterprise value of $15.2 billion. The difference between the market cap and the enterprise value is the premium or discount financial market is willing to allocate to the company based on its current fundamentals, leverage, the market mood, and asset composition. Some of the examples of impact by leverage is if the company has a lot of debt, then the market may feel uncertain about the company's capacity to pay back its interest and principals, which may then negatively impact its profitability and solvency. Another key element to understand is the asset composition of many companies, and it is especially true for growth-type companies. For many of those, one of the most significant assets they own is called goodwill. Goodwill is the expectation of the market that the company can generate more profit or to acquire bigger market shares than the competition, partially because it has a good management, stronger brand recognition, bigger following online, and so on. In other words, it's not a tangible asset that companies can use. However, it's often the reason that some companies are perceived to be trading at a discount, because the market cap is lower than the enterprise value, which is the value that market gives to its assets once debts are paid off. In comparison to its historical price fluctuations, the stock is 8.7% higher than the 1-month low, 8.7% higher than the 3-month low, and 8.7% than the 1-year low. Regarding the options market, which often gives hints on the market sentiment on where the stock price is likely going to head toward, the implied volatility is 71.7%, compared to a historical volatility of 59.4%. The put-call volume ratio is currently at 0.28. The most recent volume of options traded has been 73,000 contracts within a day, compared to the 30-day average volume of 106,000. In terms of open interest, the most recent volume of open interest has been 1.3 million contracts, compared to a 30-day average of 1.3 million contracts. In terms of its shareholder structure, institutional shareholders own about 45% of its outstanding shares. The biggest shareholders include SoftBank, Vanguard, and Silver Lake Group. The relevance of the shareholder structure is important to determine if you should hold the stock long-term or to view it as a short-term volatility play. If the stock is mainly held by retail traders, then it may be a sign that the stock lacks the depth to justify long-term trust from shareholders. Of course, there are exceptions from what I said above. Usually, the consensus is that there should be at least 25% to 30% of institutional participation for the stock to sound or to seem to be a sound investment, and not just a short-term play. Let's also look at the short interest present in the stock, which is the amount of positions aiming to profit if share price falls lower. Sometimes, if there are significant short interest in the total volume, it can be a sign that there's an organized shorting operation going on, like what has been going on with GameStop and AMC. The current short interest is 10.2% of the total float and 36.1% of the dark pool transactions. Now, let's take a look at the indicators. Financial indicators give us a hint on what the price movements are showing, what should be our tactical approach in the short term. The oscillators are showing 1 sell, 8 neutral, and 2 buys with an overall neutral tendency. The moving averages show 13 sells, 1 neutral, and 1 buy with an overall tendency of strong sell. The moving averages can be used to determine if the stock is overbought or oversold, which can then be used to see if your trade is sufficiently well timed. Regarding the support and resistance levels sprinkled in the price trends, the support levels are $11.54, $13.17, and $13.68. For resistance levels, they are $16.20, $18.42, and $24.29. Looking at Sofi as a company and as a potential entity to invest into, I think that the biggest portion of the market correction is now behind us. Sofi initially enjoyed a lot of upward momentum because the market was looking forward to the company to become the new type of bank that everyone was talking about back in the 2018 era. Sofi has a huge amount of users on its platforms, and arguably a good percentage of these users may at some point becoming, to various degrees, paying customers to its services. Sofi is essentially what DeFi platforms have accomplished in the crypto sector, but using fiat currencies. It is a decentralized platform without the infrastructure cost of traditional banks and enjoying the speed of dematerialized services. Currently, the price seems to be stable and has found some significant support levels after a few weeks of downward pressure. Going forward, I think it's safe to predict more bullish actions. Going forward, I think that it's safe to predict more bullish price actions, not necessarily because the fundamentals are different, but because those looking to sell the shares have mostly already done so, and that a subsequent price dynamic should be influenced by this new dynamic. With that being said, keep in mind that the current trends cannot necessarily be qualified as bullish, because each peak is lower than the previous one. So we can say that there are significant resistance above a certain level and arguably some solid supports below a certain level as well. There are gains that can be made between those two price points, at least for the time being. My position on Sofi is that the company should have an overall bullish tendency in the sense that we should never short it in case that a significant uptick creates a very subsequent financial loss to your short position. With that being said, I think that overall, the exposure should be kept at a reasonable level to avoid the performance of this one single stock affecting the performance of the whole portfolio. I would recommend a maximum exposure of 1 to 3% in Sofi and to hold between 6 to 8 weeks before consider selling it. Your investment should also take into consideration the market conditions and the surrounding sentiment to determine what kind of asset should be picked, for how much and for how long. First of all, the financial market doesn't reflect the real economy. If the stock market is doing great, it doesn't necessarily mean that companies are hiring people, that salaries and living standards are rising. Sometimes it's the exact opposite that happens, because the stock market is a pool of money where things come in and come out, going to different sectors to be placed. The capital may be used to be invested in a company to improve its efficiency and productivity, but it can also be used to buy up shares and assets in order to make a profit. This phenomenon is called financialization, and it means that the more money is being used for non-productive purposes like merger and acquisitions, fees to financial sectors, buying back equity, and so on, the less there is for the real economy. Another way to put it is that ever since 2008, the Dow Jones has increased significantly. But people don't necessarily see this growth in tangible ways. This is why we gotta be careful with the assumptions that rising stock price means better outlook for the company. Sometimes it doesn't mean anything. other than the fact that the asset is getting more expensive to be bought and that their yields is going down as a result. Additionally, some new phenomenons are now palpable, such as the creation of new bubbles, the participation and influence of retail traders in specific situations, and the anticipation of a massive recession or at least pullback. Bubbles have always been created on and off over the past few centuries, but nowadays it's quite interesting to see the speed at which an organic bubble can be created back in 2020. Because almost immediately after the major collapse of the financial market back in early 2020, the market decided to pour a massive amount of capital in the EV sector and anything that's related to it. Stock prices went up the sky, and for a moment, it really felt like any EV stock can be a golden goose. Another way to say this is that any SPAC with an EV company in it will become the next Tesla, right? Even if it didn't last that long, this episode definitely allowed the market participants to park a lot of their money in a sector, leaving it with either a lot of profits or at least avoiding incurring large losses because they left their money in the blue chips or the sectors heavily affected. The involvement of retail traders in companies has also been much more pronounced in recent months, especially in the scenarios of a short squeeze. Companies may have short sellers who believe that the stock will decrease in value. The short squeeze consists of buying the stock price up to force the short sellers to recover their positions, which will then also trigger an even bigger increase of stock price as a result. Of course, I'm not saying that this is always rational. I'm not even saying that those companies always have a convincing narrative. So, for example, if you play video games, ask yourself if you personally bought all your games at GameStop, knowing that you can buy the same games just online in the comfort of your home. But nevertheless, retail traders do have a much more significant influence in the stock price nowadays, for the better or worse. Personally, I think that as long as the volatility is high or gets higher, it'll create more opportunities. The final phenomenon is the anticipation of a recession. Many people have been expecting something of that sort to happen ever since 2008. There were quite a few companies that were supposed to go bankrupt because their debt structure is no longer sustainable or that their business model is bad. But overall, the system was able to hold its ground, especially in the North American market. This is partially because capital around the world often choose to come to the American capital market when things get heated back home. This is especially the case when geopolitical tensions increase around the world. In order to make sure that capital can provide a steady return without being affected too much by the central bank policies and inflations, I think that this phenomenon will increase its pace as time passes by, at least for the next couple of years. This is why we will likely see the blue chips continuing their ascension, even if for the growth stocks, things may be a lot more nuanced. The bottom line in all this is that the environment is getting more uncertain and volatile in a context where asset yields will probably remain quite low, because the real economy cannot be improved with just money. As far as we're concerned, this means that the patience would be a great virtue for all of us, and that there will be plenty of opportunities to eye for better prices. With that being said, always make sure to keep your positions diversified and keep the risk level under check. Speculative positions should play a small part in your overall portfolio. I would say it's better to keep them below 10 to 20% of your total holdings. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.